Gershon, I want to begin with you. The third mini scare in markets so far in 2019, and high yield just captures it perfectly. If you look at US high yield spreads, the floor through the year really in at around 350, the top, the ceiling, in at around 450. Is this scare any different to the previous two scares we've seen through 2019 so far?
Well, other than what we talked about in the last segment about perhaps a weakening economy, I don't think it's any different in that investors keep on coming back to they need yield, and it doesn't seem like the bottom is falling out. There aren't a lot of defaults. That's what's going on at the surface. You dig a little deeper, and you actually see a bifurcation. You're seeing if there's a good, solid double B deal, it flies off the shelf. Live Nation priced a drive-by on Wednesday when equities were down at 2% at 4 3/4. It was oversubscribed and traded up in the aftermarket. Then you had a deal like Shutterfly earlier this week was marketed for 2 or 3 weeks at 7.5%. There were no buyers. It finally priced at 8.5% and traded down in the marketplace. So investors are willing to buy things that they might not have the greatest yields in the world, but it's a lot more than risk-free yields, and they feel good about it, but they're not willing to step out, given where we are in the cycle, and buy the riskiest stuff.
Isn't that the biggest difference between now and Q4 of last year? December 2018, the primary market just shut down. The idea that we got some of these deals done on Wednesday, when the equity market was falling out of bed and everyone was freaking out over an ISM, is that encouraging to you, Gershon, that this market's still functioning?
Well, it's definitely encouraging it's functioning, but the reality is that investors are just showing, again, the need for yield. That's not going to change until it's not just the news cycles. They might pause for a day or two.
Yeah.
Mutual funds have a lot of cash. Money is still coming in. And that's just not going to change until either it's apparent that we're in the R word, I don't say it anymore, or
the mini R.
The mini R, right? Whatever that means. Or we start to see losses and defaults, which we just haven't seen yet.
Oksana?
So on the surface, we have a tremendous amount of inflows year to date into high yield, about $15 billion, and that continues to support the asset class. As Gershon said, this tremendous need for yield. But if you look under the surface, certainly you're starting to see some red flags, at least red flags for this price level, right? Because everything is price dependent. And what you're seeing is that the default rate in high yield is starting to come up about 2.5% at this point. Last year it was at about in the high ones. You're starting to see very low recoveries of the defaults that we have seen have been coming in at about 36 cents on the dollar. And a very interesting dichotomy has developed within the high yield market where triple C's tend to lead on the way up and on the way down, particularly in double-digit years, and this has been a double-digit year for high yield, and we're seeing that diverge. So in the third quarter, triple C's were solidly negative, down 2 to 3%, and the double B in the higher part of the market, higher-rated part of the market, was very positive. So that is a bit of a warning sign to me, because typically, whether you look back at 2016 or 17, or pretty much back to history, triple C's tend to be the first one's on the way up and the first one's on the way down. The dichotomy that we have broadly in fixed income, in fixed income is that you mentioned equities versus bonds, but what we have within fixed income is credit spreads are saying everything is great, and rates are telling us that the check engine light is on, so to speak, right? So one or the other has to dominate. Either rates are right, and then spreads have to widen to reflect the R word or the slowdown, or credit spreads are right, and then rates have to come up to meet kind of the sentiment that, look, everything is fine.
To put you on the spot then, what's your base case? What needs to happen?
We think that everything across the board is very, very richly priced. So even the things that perhaps fundamentally are not terrible, and certainly we're not seeing anything terrible from a fundamental standpoint, but pricing is very rich. You know, double B's in the 200s, no thank you.
Lisa Hornby?
Yeah, I mean, you look at the ratios, double B's to triple B's or double B's to triple C's. I mean, that is the most expensive point that you could possibly find. So for us as multi-sector investors, we are staying away from high yield at the moment. Our high yield dedicated portfolio managers have more investment grade than they've had in a number of years. So we're looking more towards the investment grade, higher quality. You know, I think we were discussing this last time I was on your show. 450, 430, 450 has been a buying opportunity in high yield spreads. This time, I think it's a little bit different. We are in a more uncertain economic backdrop than we were before. You know, the vulnerabilities have clearly increased in the U.S. I'm not going to use the R word. I don't think we're headed
Everyone's
there.
Everyone's so scared of the R word around this time.
You know, it's not a binary situation. It's not either we're on or we're off. It's a slowdown. But in a slowdown, you want to start to avoid and become more defensive and liquid in your portfolio.
Gershon?
There's a lesson here for investors. The world is delivered to you. Either you're buying a credit fund that focuses primarily on high yield, or you're buying a duration fund. And the credit people are never going to tell you that high yield's not a good place to be, and the duration people are never going to tell you shouldn't buy duration. That's why I'm going to say the same shameless plug I said last time. ACGYX, we balance the half of its credit risk half of it's rate risk. Given that we don't know which one is mispriced, balancing the two together is a very smart strategy. It's just not the way most people invest.
The problem is both of them are viciously overpriced right now. And, betting on rates to go from all-time lows to new all-time lows is a gamble. Like, no one knows. Markets have gotten this consistently wrong time and time again. So today, when the curve looks the way it does, and you can still earn 2% on the front end of the curve, and the 10 years offering you 1.6 with a ton of duration risk. I hear trades like you can buy Japanese bonds and then hedge them back to the dollar. And after all these three-legged trades, you end up with the rate of U.S. cash, essentially. And why would you take all that risk? So
you're returning your investors' money.
So we are being very cautious here and focusing on safe carry. And a big part of that are liquid floating structures. And you can continue to be there and clip a very conservative coupon and be ready for volatility, which is coming, because what's going to bomb everyone out at the end of the day, rates and credit, is math. That's the new word I'm introducing here, because fixed income is a mathematically bound asset class, and we are getting very close to those bounds.
Oksana, Aronov, Lisa Hornby, Gershon, Distenfeld, sticking with me.